All right. Well, we are going to just go over the very basics of options and feel free to type something in the chat or unmute and ask questions if you have questions. Brenda put together this presentation, and so we will send it out afterwards. We'll send out the recording of the webinar, and then we may get off of the presentation just a little bit, but we'll send out both. So we are recording. So what is hedging and why do we do it? A hedge, by true definition, is something we do to reduce risk by taking an offsetting position. Let's see here. It's not necessarily about making money, but it's more about limiting loss. So as farmers, there's three basic hedging tools. We've got futures contracts, options contracts, and then forward or cash contracts. A futures contract is basically, as we know it, a straight hedge. So we're locking that in. We're going to benefit as price changes 1-to-1. So if we're locking in corn at 450 with a futures price as farmers on the hedge side, we are long the physical commodity because we have grain in the field. And so we're going to be taking a short position on futures. So if the price goes down, I'm losing money on the corn in the field. I'm gaining money in my futures position and my hedge account 1-for-1. So if corn goes down 5 cents, I'm making 5 cents on that futures position. Vice versa, if we lock in a straight futures hedge at 450 on corn with straight futures and the market goes up, I've locked that in completely. So I am losing 1-for-1. My corn in the field is worth more and my futures account is worth less. So it's offsetting that risk 100%. One thing to note is that grain contracts are 5,000 bushel increments. Forward contract is going to be a private agreement between you and the elevator or the end user, the ethanol plant, the feed yard, things like that. Spot would be just selling across the scale, may not be in 5,000 bushel increments, may be in any sort of increment. And then a basis contract would be, you've got on a cash contract, you've got two components. You've got your futures price, you've got your cash price. Futures price and basis goes up to make a final cash price. So basis is going to change and fluctuate throughout the year. The futures price is going to change and fluctuate throughout the year. So both things contribute to that cash price. And as a hedger, you can set the basis at different times or set the futures and leave the basis open. Jeremy, do you want to
One
touch
thing
on, why
yeah,
we may want to leave basis open or why we may want to set basis and leave futures
yeah.
open?
Well, first off, the one thing that we recommend is you got to know your local basis. I mean, if you want to do a good job of being a grain marketer and you want to be a price maker instead of price taker, you got to know what's a good basis for you. So, is your basis locally typically the same as the board? Is it 50 under the board? Is it 50 over the board? The basis for corn down in Texas, where there's all the feed demand, is a lot better than the basis up in, say, South Dakota or North Dakota, where they got to truck it all the way down to Texas or put it on rail or find an ethanol plant. So you want to know your local basis. That's number one. And number two is if the market is inverting, which means if the local cash price is worth, say, 50 cents more today than it is a month from now, well, it's like charging you to not do a basis contract. That's the time you want to do a basis contract, is when a basis is really good because they need the corn right now, and you want to make sure that you go ahead and participate in that. When you don't want to do a basis contract, generically speaking, is when the price for corn today is significantly less than the price for corn a month from now or 2 or 3 months from now. That's just a trap for the end users, the buyers. I mean, that's when they're using that tool to make money off you. When you guys can do a good job of utilizing that tool is when basis is significantly higher or the board is significantly higher today than it is 6 months from now, a year from now, 3 months from now, etc. And so that's really when you determine if you should use a basis contract or shouldn't. Number one, is it a good basis? Number two, is it a lot higher basis today than it is later? And if the answer is yes, then you should be looking at a basis contract. If the answer is no to both of them, then you probably shouldn't. You always want to though consider it. I mean, a lot of times what's happened talking to the guys here the last few weeks, there's a lot of places in Nebraska and Colorado where basis is 20, 30, 40 cents better. So what typically happens is there's a lot of feedlots in particular that are flat price buyers. So if the board goes down, basis gets better. If the futures goes up, basis gets worse. So it's kind of a double-edged sword, so to speak. A lot of times, if futures are going up, basis is not going to stay as strong. It's going to get weaker, and the opposite is going to happen a lot of times when the futures are going down, basis is going to get better. So that's one of the reasons you want to try to lock them in separately is so that you can gain on both of them.
Yeah, and explain that one more time because it sounds counterintuitive. So the board could be going up and basis is going down, or the board could be going down and basis is going up. So explain that one more time because it does, sometimes
Yeah.
it's worth walking through that again.
So like let's just say that the corn board is 450 and it drops down to and you can sell corn at 450. That'd be a zero basis. And let's just say the corn board futures go down to 430. Well, now that same cash buyer might still be willing to pay 450, so his basis has got 20 cents better, even though the board went down. So if you can separate the two, what typically happens is when the board goes up dramatically, then basis gets weaker. When the board goes down dramatically, and then basis usually gets better. So recently, a lot of the flat price buyers have had basis get better because the board's lost 20, 30, 40 cents, 50 cents here in the last couple months, last month and a half. So it's usually just an inverse relationship is basically what it is. One gets up better, the other gets worse.
Yeah, the basis is also going to tell us a story. If the board is, say, flat, not doing anything, but basis is increasing, that means that cash buyers are having to pay more to get corn bought or beans or whatever, wheat, whatever it may be. So they're having to pay up to get it bought on the cash market. They're have to paying up via basis.
Yep.
So also if we may think that we've got a short crop, but basis isn't increasing, they're not having to pay up to find it. That's a sign that basis will show us whether we're short or not, and it starts in a local area and then it moves more starts regional and then moves broader. So
Yeah.
if we truly are short crop, basis is going to start telling us first.
Yeah. And you'll see it a lot of years when there's a drought down south, down in the Texas area, all that feed demand will be pulling up from up in like South Dakota, North Dakota, will be flowing down there and it'll help our basis get better. And then all of a sudden, the guys that are usually buying our corn have missed the boat and then their basis starts getting better. So it kind of circles around. I mean, when you get into tighter supply situations.
Okay. So moving to options. So a call is an option that gives the buyer the right, but not the obligation to be long futures. So I can be, if I buy a call, let's say a $5 December call, corn call, I'm going to make money when the price goes up. But I'm a buyer. And so if price is at 450 and I want to be long at 5, well, I'm not going to exercise that call because the market is cheaper. So let's look at a corn chart here. And here's December. So if I'm buying a call at 480, let's see here, I make money on the call when the market goes up. So I have the right, but not the obligation to buy corn at 480. Now that call becomes worth more and more valuable as the market goes above 480, above 5, above 510, etc. But if the market sells off to 450, I don't want to buy corn at 480. I want to buy it at 450. So then that call becomes worth less as the market goes down because it's not as valuable for me to buy that call at that strike price.
Yeah, I always look at call options kind of like insurance. And basically, the longer you want it, the more it costs you. The more volatile of a driver you are. Like if you're an old grandma that hasn't had a speeding ticket in 30 years, your insurance is going to be a lot less than my teenager that's got 5 speeding tickets and has a DWI or something like that. And those are the two big components. Is number one, if you want to have it for a short period of time, a week, it's a lot cheaper than it is if you want to have it for a year. And number two is, well, how volatile is the market? If we're going up and down a bunch because one day Trump's saying something driving us 20, 30 cents higher, next day he's not saying anything else, we're down 20, 30 cents. Or if we're in a weather market where one day it's hot and dry and there's a dome building, the next day it's too wet. I mean, the more volatility out there, the more your options are going to cost. And like I say, I always refer to them as insurance. And there's sometimes when I want to be a guy that's buying insurance, because I need that protection. I just want to make sure that I'm going through a hailstorm right now. I don't want my car to get dented up, so I got to buy that insurance. Or I got this weather event happening, and as far as corn goes, where I don't know what I'm going to produce. So sometimes I want to buy that insurance to lock in good prices. Maybe I want to lock in reownership. I mean, you can buy a call option to reown something. You can do it for several different reasons. So um,
Yeah. So let's start with, a call. An option, first of all, is the right but not the obligation to have that position. A futures contract is you're obligated to that position and it's locked in. But you're going to pay for that flexibility of the option. The cost of that option is determined by, like Jeremy said, it's determined by the intrinsic value. Where's that strike price? That 480
we'll
call.
look up there, but I'm on
If that 480 call, if the market's at 480, that strike is at the market. If the market is at 450 and your strike price is at 480, that is considered out of the money. If your strike price is at 480 and the market's at 520, then that's considered in the money. So in the money, out of the money, at the money. So your strike price is the intrinsic value. If I have a 480 call and the market's at $5, intrinsically that option is worth 20 cents. But then you're also going to add in the time value. So the longer time horizon a market has, the more chance is that it can move, over the course of that time period. So it's going to have a set days till expiration on that option, and you're going to have to pay. For more time comes more cost, less time comes less cost. So the portion of that option pricing is intrinsic value, time value, and then volatility. So if a market is moving, 10, 15 cents a day, the average daily trading range could be 10 or 20 cents. That option is going to be more expensive than a market that has a 3-cent trading range every day. So because the inherent risk of a market that's really moving and highly volatile is more expensive, the risk is higher than on a market that's not doing anything. So when we look at, we probably in this call won't get to should we do things. We're looking at just the kind of the basics. We may be at a highly volatile market and should we buy options? Well, just a long option, if it's a very volatile market, that's going to be relatively expensive because that volatility is high. And if we're in a relatively slow market, that volatility is low, we may want to be long options. So there was a time whenever earlier in the year, was it probably right when the war started back in March? Our recommendation was we want to be selling options, not buying, because there's times when you're paying for that volatility, you can be right. But if the volatility slows down, say price just gradually starts moving instead of volatility starts moving, and then the value of that option comes down and you're right in the flat price, but that option still lost money. And there's other times where you can be, vice versa. You can be wrong in flat price, but the volatility and the time value dictate that. So,
I always think of options. It's really easy to know what they're going to do at expiration because it's just we're either above that price or below it. But anything between now and then, there's all these delta factors, the Greeks they call them, the implied volatility, the theta and beta, that it makes it really difficult to know exactly where you're going to be able to be at on a given day without knowing if the market's super volatile, without knowing what day it is, without knowing any of that. Whereas at expiration, it's black and white. But between now and expiration, options have plenty of complexity to them.
Yep. So let's look at your delta is going to be your percent change. So August corn, it's against the September contract and it has 29 days left. So September, let's go, we settled at 424 and a quarter. So at the money would be a 425 call. So an at the money call is going to have 29 days till expiration, volatility 31 vol, and your delta is 50.9. So 51 delta. So options at the money are usually going to have a 50 delta. That means if the market goes up $1, that option is, or say the market goes up 10 cents, that options in theory is going to go up 5 cents. You're going to get 50% of that move on a 50 delta option. If the market, let's see this 325 call, the market hasn't been to 325, so you wouldn't have ever bought that. But the delta on that is going to be 99. So that deep in the money option is working almost exactly as futures. Futures are at 100 delta. Deep in the money option is going to be like a 99 delta. So let's say back when corn was higher, if we bought a 510 put, that delta, now it's in the money, that's a 94 delta. So you're getting 94% of that market movement. Whereas with futures, you're going to get 100% of that market movement. If you're buying a put here, 425 put, it would cost 15 cents. And I'm looking here, the delta would be 49. So if the market, there's times when you may say, well, the market's going down. How come my puts in theory increase in value as the market goes down? But since it's an option, it's not going to be 1-to-1. It's going to be whatever that delta is. It's going to increase deltas as it becomes more in the money until it becomes deep in the money and that delta goes almost to 100. But it's not going to be 100 until it goes to expiration. So, an at the money put is going to be a 49 delta, whereas that deep in the money put was a 99. If we go out of the money, let's say a $4 put, 5 cents, that delta is 23. So in theory, if you want to be equally as protected, if you want to be 100% protected from market movement, you would need to buy 4 of those to get a 100 delta. But at expiration, it's going to go up as we get closer to expiration and closer to the strike price of the market. That delta is going to increase or
So,
decrease as the market moves away from that strike.
so as a farmer, if you go in and buy that $4 put, what you've essentially done is you took that $4 as your floor at expiration minus the cost of the option, and it looks like it's a nickel. So you basically created a 395 futures floor when you bought that, and that's where when she's talking about the delta, I mean that's at expiration. That's it. It's 395 period. It's easy to component, but if you're like, hey, what happens next week if corn goes down 3 cents or nickel or a dime? It's going to be a lot. It's going to be dependent on where's that delta at, how much time's went by. I mean, you see that these things have 29 days left. Well, they're not going to be worth as much when there's 5 days left as they're when they're 29 days. And they're going to be worth a lot more if there would have been 50 or 60 days left.
And so we can also have different time value components of each option. So the August has 29 days left, expires July 24th, but it is a derivative of the September corn contract. We could do September options, which are 100% against the September contract, 57 days left. So they have the same underlying price, 424, 424, one with 29 days left, one with 57 days left. The $4 put with 57 days left cost 7 and 5/8. 425 at the money put was 19 cents versus 15 cents. So the market is making you pay an extra 4 cents for that extra 30 days of exposure. So those are against the September. If we're going out to December options, 148 days left, closed at 443. A 440 put, which we touched on calls, but puts make money when the price goes down. But you have that option premium cost that you have that hurdle. So they're going to make money as the price goes down, but you've got to pay that option premium. So if we buy a 440 put and the market goes down to $4 at expiration, I would gross 40 cents, but I'm going to net, whatever I paid for that option at the time, which, depends on the day, where the market is, how much time value is left, and how much volatility is in that option.
So it'd be 16 and a half cents if you paid the 23 and a half. Right.
Yes. No, it would be 40 minus, yes, yeah. So the 23 and a half for the 440 put in December, it's got a delta of 45. So it's just still, 3 cents out of the money. The market's at 443. And it's got a volatility of 22. Or we could do, so that's against the December contract, 23 cents. There's also short dated options that expire. They're against the December contract, but they expire any month. It's going to be at the end of the month. So you could do, yeah, make sure we're going off settlement prices. So if we did something 57 days left, that 440 put expiring August 21st would be 17 and a half versus the 23 and a half. So 6 cents for an extra 100 days. And then it becomes a decision. Do I want to pay for that extra time value? Do I not want to pay for that extra time value? So if we do the short dated options any option when it expires. So if I have a 440 put, if the market's at $4 at expiration, that converts into a short futures position. And then if it's in the money, converts to a short futures position. And then I can treat it as a true hedge. So if I had let's say I have a short dated December option that expires tomorrow. If I bought that put at $5 and tomorrow the market's at 440, I would either have an option that's worth 60 cents and I would get out of it, or I would let that convert to futures and I would have a short futures position at $5. So if I was a farmer, I still needed that coverage and still needed the hedge. What I would do is let that convert to futures and I'd have that short futures position at $5. And then what I could do is, maybe I put that position back on before planting. Now we're after planting, we've got a stand, we have a decent idea of what we're going to produce. And now I feel comfortable transferring that position over to a cash contract with the elevator. And now it becomes a, deliverable contract at my hedge price.
And that's where knowing your basis really becomes important. When the ideal time you would do that is when you see a basis that you like, that you're comfortable with, that nets you the net price that you're trying to get when you originally put the hedge on. And if it's a better basis than that, then that's great. If it's a worse basis, then it makes you have to redetermine what your right decision is.
Yeah, there's going to be advantages to, locking it in with the elevator. I don't have that cost to carry that hedge. I still have the same risk. I'm still exposed to the market, whether I choose to participate in it or not. But, if I go do a straight cash contract with the elevator, they're carrying that hedge, but I'm locked in to delivering to them, potentially locked into taking whatever basis they want to give us at the time. Could be good, could be bad, or I already know I'm going to deliver to them anyway, based on location. And then there's times when it may be better to do those options in your own hedge account, let those convert to futures as time goes on, and then enter into that hedge, into that cash contract later.
See, I'm really big into farmers should use their own hedge account and try to act like an elevator. And I know I'm selling the tool too, but I just feel like when they use the elevator to do a cash contract or do an HTA, they give up all their leverage. So they no longer have negotiating power. If the elevator goes broke, oh, by the way, your contract's no good. I mean, I've had that happen to several guys that dealt with Verisun in 2008, where they had some corn sold, they had it hedged on the board, their banker made them lift the hedge. They sold it to Verisun, and when the net deal was done, instead of getting $7 corn, they got $2 plus corn. So, I mean, I've just seen a lot of bad things happen when guys try to do stuff with elevators, that they just end up, it feels like they always giving up at least a nickel, and sometimes um, more than that. I mean, and then the other thing is, if you want to, like, I had a lot of guys this year that I had some guys that want to get out of some wheat contracts because they were going to grow wheat. Well, the elevator was bidding 50 cents less on wheat, yet they wanted 50 cents to a dollar to get out of the contract. Whereas if the farmer just had it on his hedge account, he got out of it right then and didn't have to worry about it. There are just so many advantages, in my opinion, that farmers should have their own hedge accounts, put their big boy pants on, and not let the buyer take advantage, because they have all those ways that they make money on it, whether it's the rolling it when they make money on the carry, whether it's not getting you out at the same price that you could get out on if you say had sold something, now you decide you didn't want to be in it. If it's the flexibility you have, if say you sold futures, made money on it, you want to take that profit, lock it in, and then the board goes back up, so you decide to resell it again. I mean, all that flexibility that you have with your hedge account. So I'm a really big component. I think when you use the elevators for DP, HTAs, even basis contracts that you're not going to deliver right away, I think you just leave millions and millions of dollars on the table. But that's my biased opinions.
Okay, so we just have a few minutes left. We're going to keep it to about 30 minutes. But in general, calls make money when the market goes up, puts make money when the market goes down. As a farmer producer hedger, I have, if the market goes up, I make it on the grain. So I need protection if the market goes down. So I'm going to be generally buying puts. When would I be buying a call? Well, I might be buying a call. Let's say say I sold cash up here at $5 and the market's now down here at 430. I've got $70 of equity, and it could be in futures, could be in puts, it could be in a cash contract. Now, let's say it's in a cash contract. Let's say I forward contracted, 100,000 bushels with the elevator at $5, plus or minus whatever the basis is. Now the market's sold off, and I've got all that equity on that cash contract. If the market goes back up, then I'm forfeiting some of that equity. It could also be an insurance payment, government payment, things like that. So now I'm protecting myself. I know I'm protected if the market goes down because I've sold it, contracted it. Now I'm going to buy calls to protect myself if the market goes back up. Or maybe I did an accumulator contract with a double up, and the market has moved away from that strike price, and it's reasonable and affordable now to hedge off that double up risk. Or maybe I'm in like wheat this year where it's potentially maybe a short crop, and I've got to hedge myself against not being able to deliver on that contract. That would be times where I may want to look at buying calls, even though I've already, on a producer, I'm already am long the physical. I may want to take a options position with calls to hedge off that equity, or may want to look at. Jeremy likes to talk about courage calls a lot. So what courage calls do, I'm going to buy them to say we get a 50% retracement back of this move that puts us back around 465 to 470, somewhere in there. And that's where I really want to put my hedges back on. I might want to buy some calls for $75 to where if the market goes back up, I am comfortable and I have the courage to make that sale and be aggressive in managing my downside risk, because I know if it keeps going up, I get to participate through my options. So they help us make decisions. They help us execute on that plan easier whenever I know I bought them whenever they were cheap. So that's when, as a hedger, I may be buying calls. When would I be buying puts? Be buying puts to protect my downside. Maybe in the future, we may want to buy some, on options, we want to stick to something that's reasonable cost because that time value and the volatility, can chew up in, we have to make sure we're looking at the net cost, not, including the cost of that option. When would I maybe sell puts as a hedger? Well, maybe I would do a put spread where I'm buying a 470 put and I'm selling a 440 put. So I have my downside protected to a certain level, and I know that my crop insurance maybe kicks in below this level, or I'm comfortable taking risk below this level. So I don't need 100% of downside coverage. I want 30, 40, 50 cents to get it at a more reasonable price. I just want the biggest portion of that. So we're buying one and we're selling one. We may do that on calls also. We may buy a call at $5 and sell a 550 call. So I don't need unlimited upside. I want to reduce the total cost of that option premium, and I want to get a window of protection instead of, unlimited protection one direction or another. As a hedger, when would I be selling calls? Selling calls is going to take the opposite strategy. So if a call makes money when the market goes up, selling a call loses money when the market goes up. So you're going to collect that option premium. So say I sold a call for 20 cents, I'm going to collect that option premium. And then as a producer, if it continues to go up, well, it turns into a short futures contract, which is good for me because I've got the corn to go against it, becomes a straight hedge. So a lot of times we'll buy a put, say 470, put, we'll sell a 525 call. So now I've got a window to be hedged. I've got my floor set with the put, and I'm going to cheapen that up by collecting that option premium on the short call. And so, between this level, between 470 and 525, I'm at the will of the market with my cash, but below 470, I'm protected with my options. Above 525, it's essentially acting as a ceiling or as a hedge. So we only have a few minutes left. We're going to wrap it up. We will send the spreadsheet out or this presentation out. It goes a little more in depth into options and how they work for a hedge strategy. Feel free to give us a call anytime with any questions or email us with questions. Also, if you're looking for more market updates daily, look at Daily Market Minute for the commodity insights that come out for that. Do we have any questions or anything you want to add, Jeremy, before we wrap it up?
I don't think there's anything. I just make sure you guys try to educate yourself. There's a lot of advantages using the tools out there that the buyers are using. So if you can get in the way of using it yourself, it's going to be advantageous to you.
All right. Well, we're going to continue to do some more webinars, and we're going to try to do these once a week or every other week. And so if you've got some specific questions or you've got some topics you would like for us to cover, just let us know. Shoot us an email, send us a text, give us a call. Thanks. Bye.
Thanks, Lauren.